Hello, and welcome to the Performance Leadership Learning Lab's Virtual Roundtable on the deal killers you can't see in a spreadsheet, how AI is changing due diligence. We're glad you're here. A couple housekeeping items as we get started. If you do have questions for today's panelists, please insert them into the chat. We'll leave time at the end for those questions as they arise. And then secondly, if you did join us today, or if you weren't able to join us, you will receive a copy of the roundtable here after tomorrow. So we will be happy. You'll be receiving an email from that section or from this session. So let's begin with introductions. I'm Will Gladhart, Chief Marketing Officer at the Culture Think Tank. I'll be your host and moderator today. I'd like to ask each of our panelists to give a brief overview of their role and their background. Mark and Charles, we'll start with you, and then Lindsay, and finally Will Lindstrom.
I'll start. I'm Mark Iorio. I'm one of the partners at BCAT Partners, which is part of Exit Systems. Exit Systems is an organization that's founded by Charles Dentz. He'll talk to you in a minute about helping organizations prepare for an exit. So great to be here.
Thank you.
Thank you, Mark. And yes, Charles Dentz, founder, CEO of Exit Systems, and so glad to be here. We founded Exit Systems simply to do this, is to help the unprepared business owner be prepared for a premium exit.
Perfect. Lindsay.
I'm Lindsay Gazowski, founder and CEO of the Crucible, which is a leadership assessment that was specifically engineered for investor-backed companies and for leadership teams that are looking to become investor-backed. I'm also one of the partners in the Performance Leadership Lab Alliance and excited to be here today.
All right, great. And Will.
Yeah, so William Lindstrom, I am the CEO and co-founder of the Culture Think Tank and one of the partners at the Performance Leadership Learning Lab as well. And we primarily focus on developing solutions, SageForge being one of them, that provides the leading indicators that drive growth and ultimately help accelerate speed to exit for those companies that are looking to be sold.
Great. Well, thanks you for those introductions. We'll begin with a thought-provoking question from Charles to kind of kick it off. Can you walk us through how a PE firm or an exit planner might use your technology to assess a company's exit readiness?
Sure can. When we look at private equity teams and exit planners themselves, there's this increasing desire to seek and quantify the exit readiness, both from an operational standpoint and as well as with financial indicators. The process typically begins with a short diagnostic. We use it as an intake. It's AI driven. And then we also collect from that, not from that, but also collect from a client a 24-month review of their financials, customer, HR, pricing data. And the goal is to really normalize the performance and benchmark the business against peer companies by size and industry. And when we gather that information, the output is usually presented across a few core dimensions. And those dimensions are revenue and quality, or revenue quality itself, as well as customer concentration, or hopefully lack of customer concentration, but pricing power, margin realization, customer retention, satisfaction, operational throughput, working capital, from a discipline standpoint, working capital discipline, and then leadership autonomy across succession depth itself. And when all that's said and done, the dashboards enable really decision makers to move beyond spreadsheets and assess what's, the risk and the opportunity through a systems level view. And then for PE firms, it informs pre-LOI and 100-day planning. And for advisors, it shapes readiness roadmaps tailored for unique levers that we use. And then what that does is then it helps drive value within the business.
Excellent. Well, and so any other thoughts or comments? I know that both Lindsay and Will, use, we have, parallel technologies that are AI driven to, work and enhance those valuation pieces. So any other thoughts on that particular element?
I can touch on that. I think the biggest difference what you're seeing in the industry, regardless of kind of which technology, but where AI is kind of shaping it, is largely AI is simplifying the process of getting organizations' financials and other key metrics into a shape that can be better evaluated from a due diligence process. And then also, I think you'll start to see AI being used largely to also help prepare companies with regards to the adjusting entry. So I think largely what AI is going to do is speed up the process for companies to get their financials and their books ready for review. That'll streamline the due diligence process, which will help everybody. It still doesn't avoid the need to make sure that your financials are still solid, but it does speed up the process of actually getting there. So that's where I see the trend go.
Great.
And I think that it's important to recognize that AI is also being used on the evaluator's side to speed their process in trying to, for instance, on contract review and some of the other elements that used to take a long period of time. They're able to feed some of that into various AI tools and expedite their ability to understand where they need to push more deeply and where they can rely on that high-level overview. I think having dashboards, tools, and software that can enable both companies and the funds to be on similar pages faster is helping to increase the knowledge share and enable that desire for quantification to be well utilized by all groups.
Mark, I saw you nod your head. Any thoughts?
Yeah, no, I think Will, it's as Charles pointed out. I mean, one of the things that we look at is the financials have to be forward thinking as well. So we've got we're working with partners that help us with forward thinking guidance and forward thinking financials, so that when buyers come into the process, it's not just backward thinking or backward looking numbers that maybe your CPA might be putting together. So it's just as equally important to look at those that FP&A.
Yeah, so great point. I think this dovetails really awesome with our next question for Mark. What role does leadership dependence play in diminishing enterprise value during a sale, and how can it be measured in advance?
It's interesting. We use a process that's scientific in nature, and we try to get everyone to imagine their team as though it were a single person doing its best work on its best day. And oftentimes Charles and I have seen that the bench strength is not very deep. And so in our process, what we do is we get everyone to make a promise each day to help migrate the culture of their organization toward this new North Star. And in doing those workshops, we begin to see emergent leaders come out of the process. So it's not just one leader, it's not just two leaders, it's an emergence of other leaders within the organization that help strengthen and broaden the bench, the leadership bench in the organization. You hear people talking about the things that they enjoy doing at work each day. They become more engaged in the work that they do. They become elevated because the leadership team are in those workshops, and you start to see people who are now taking a different role in the organization. When a buyer comes in and looks at that, they appreciate the fact that the strength is deep and it's broad. So as that process unfolds, communication gets better, Silos break down, the passive aggressive behavior starts to diminish, never goes away fully, but you start to develop that level of leadership that's much deeper, much broader, and people who you think are not really interested in leading the organization or being a part of a leadership team start to emerge, and it's quite a it's enjoyable to watch. They become better versions of themselves individually, which overall help the organization become a better version of itself. So the whole process, Charles probably didn't mention this, but we have 18 different levers in the organization that diagnostics tool looks at. And culture is one of the key ingredients of that. People are a critical role. They play a critical factor. So, you know, that's what we're looking at. We're looking at those emergent leaders.
Any other thoughts from the group?
I'd like to add one, just quickly to what Mark is saying, because he really nailed it. But buyers, when they look at this, they're looking either for fragility, you know, if it's the organization's fragile or if it's resilient. And, you know, to measure that risk goes beyond just titles and a structure. You know, what they're really looking for, or what really should be done rather, is, you know, the earlier that is assessed, you know, the more time it is to de-risk it. And because buyers simply pay for repeatability and not for charisma, because sometimes the charisma is what's driving a company, but that's not what will sustain it.
Great. Lindsay, any thoughts?
Just to Charles's point, I mean, resiliency is actually something we measure directly in the Crucible, because it's one of those essential elements that having a form of adaptability as an organization requires that resiliency. The flexibility is strength, and being able to do so both culturally and through your leadership really can mean the difference between an organization that is primed for a successful exit, a successful hold period, and even more so, a successful future.
Excellent. All right. Well, Lindsay, to dovetail into that, yeah, what do you see as the most critical KPIs you recommend looking at, but also standardizing for due diligence readiness across companies? And, you know, does AI play a factor in that as well?
Yeah, so this is probably going to be a longer answer than most people want to hear. But when you're going through an exit process, there are a lot of components of diligence that the fund is going to be looking into and that the company needs to produce on a quick basis. And I always recommend to people you should start preparing for your exit as soon as humanly possible. And I don't mean 6 months before you exit. If you're thinking you're going to exit 3 years from now, start to get your financials in order so that it's easier to continue to update and iterate rather than having to create from scratch and then being told that things aren't quite right and you need to go back and do stuff all over again. So there's sort of a couple categories of KPIs that I think are absolutely critical. The first are financial. You need to know all of your information about your historical financials and reporting, both from your accounting standpoint, but to the point made about, you know, FP&A, understanding sort of the trend lines on those factors as well. Operating cash flow, your gross and net profit margins, your revenue growth rates, your, you know, even things like customer acquisition cost, lifetime value of customers, things like that that are going to be critical for differentiating your business from other similar entities that the financial sponsor might be looking at in the market. The second thing are operational KPIs. Understanding, you know, if you're in a manufacturing scenario, production assets, inventory turnover, days sales outstanding, you know, your supply chain metrics, having elements like that, labor utilization, knowing all of those components, which you should be measuring anyway, but a lot of us aren't in some of these smaller businesses, or aren't in a way that is consistent with market standards. And so having those components. Third are the customer and market KPIs. You want to know everything about, and I mentioned a couple of customer metrics earlier, but understanding your total addressable market, understanding your current market share. If you measure net promoter scores, having those consistent and measured across time, churn rate on customers, and margins by customer and by product line, so that you know where you're adding value and where you're not. And then, talked before about legal things. You do need to have all your contracts in order. There aren't necessarily KPIs around that, but you have to know where they all are and be able to have them ready and knowing when they come due and all that good stuff. And then the last aspect, which I think are probably some of the most important, but some of the least quantifiable historically, are when we get into some of these human capital metrics. So understanding, what is the cultural health of your team? What do your leaders look like? Where are they most successful? What's your turnover rate? How happy are people? How much anxiety are they feeling? Where are people excited about the future of this organization, and where are they not? And knowing all those components can really be a differentiator. And I know that was a lot of things to throw at you as to the most important stuff. Having your financials in order is absolutely the most critical thing out there. But the difference between a good exit, where you have clean financials-ish that can then be translated to a buyer, and a scenario where you're able to demonstrate across a bunch of different vectors where you add value and why you're a better bet for the future, is where you get that extra turn, that additional juice in the transaction. So, and to the AI question on that, I think that it just makes a lot of the stuff easier. You can help standardize this with market standards. You can take things from, homegrown systems and turn it into something that looks like what would come out of other stuff. Being able to collect data very quickly. Now, I will say that making sure that whatever tools you're using are providing the correct information is important, because if there are errors or gaps in that, that is a bigger problem than not having the information at all. But having a good, solid, validated tool that can help you make your lives easier in collecting this information enables everyone to get to the meat of a transaction, which is, what are we going to do with this business from here? Is this the right vision for the future? And are we the right team to partner up to make it happen?
Yeah, great. Will, I saw you nodding your head a few times. Any thoughts?
I was just going to say that I think where AI, and I agree with everything that Lindsay's saying, and I think where everybody kind of needs to be aware of is that I think the funds and the investors are going to be adopting AI and leveraging it more readily or more rapidly than the sell side, than the individual buyers. So you have to be prepared for the fact that whatever information you're giving them, they're going to be able to go deep into the analysis very quickly now, because they don't have to do it manually. So I think this gets back to Lindsay's point of, you have to make sure that all of your information is not only cleanly put together, but also make sure that it's right. And again, I think it also touches back on to Lindsay's comment that, you can't start the exit planning process too early. And I think another way to look at exit planning, if exit planning is in fact making sure that you have everything in order, making sure you have good, clean financials, making sure that you know where your leaders are aligned with the workforce, that's actually just good business. So in some ways, there's not a difference between good business and exit planning. It's just having that discipline early and having it very strongly established is going to make you very successful growing, which is going to give you a better valuation. And then when you go into the due diligence process, you'll be better prepared. And with AI being on the other side now, I don't think you can be too prepared. You almost have to over prepare now with the capabilities that the funds have in taking a look at your.
Yeah. Any other thoughts for the rest of the panel?
Yeah, I do. I love what both Lindsay and Will said, and just spot on. And underlying what was said in terms of these essential KPIs and metrics is data governance. And I'm not talking about just security. I'm talking about having policies, controls, processes that ensure that the data is accurate and consistent. And then if all of those are in play, that means it's reliable. And so it removes any weak governance because that will undermine the dashboards like what we create, these AI-driven real-time data dashboards. And if all of that data governance is not solid, it really undermines the trust in those dashboards and the forecast they create. Then ultimately what that does from a buyer standpoint, it creates when those things are in place, it creates confidence from a buyer perspective in the forecast, and then that directly impacts valuations as well as terms. So that's additional thoughts I have on that.
And for me, Will, it's really about the alignment between the team, the leadership team, the marketing and sales team, making sure that the commitment that you make, the brand promise that you make out there in the marketplace is consistent with the delivery of the brand promise. So are there brand ambassadors within the organization, and do people see that consistency of message? When I make a promise, am I delivering on that promise? And while Lindsay said that some of those KPIs are hard metrics, we actually have a hard metric for index of alignment. We have several indices that indicate whether or not the team is in sync or rowing in the same direction or singing from the same sheet of music as the leadership team and the rest of the organization. So I think when buyers come in and they look at the organization and they hear that level of consistency and they see the behavior in the organization that's consistent with the brand promise that they make, I think that's also very critical. So, we're with our process at Exit Systems, we have that index of alignment. So that's a critical piece of this.
Excellent. Well, thank you for sharing those thoughts. We'll cast this question to Will Lindstrom. In your experience, what signals indicate that a founder or owner isn't ready to step back, and how do you actually address it pre-sale?
Yeah, so I think, leadership preparedness is really important. Like, the leader needs to be, or the founder of the organization, even if they are, financially ready, they have to be emotionally ready. So I think it's really important from that perspective. And so if you start to look at what are the behaviors, they'll start to, slow the process down. They'll start to get cold feet at the end because they're not prepared. And some of the ways that, some of the funny questions that I've heard people use that they'll ask is, can you, they'll ask the founder, can you go on vacation for 2 weeks? And, if the founder says no, the founder isn't separating. And so you have to try to figure out, why not, and bring in the second bench, or, bring up those leaders. And then, if they do say yes, then they'll ask the question, well, can you go without your laptop? Can you not take your phone? But I mean, those are the types of conversations that I think you need to have with, especially the founders themselves need to have with themselves, the family, and all that sort of stuff. And then also, what the founder wants to do needs to be more than, another question that I've heard people ask in my network, when they're looking at this is like, what do you plan to do? And if the founder says golf, well, that's not really a plan for afterwards. Like, how much can you golf at? And people think they can, but you can't. They'll tell stories like this one gentleman golfed and his shoulder swelled up and then he couldn't golf anymore. So he's like, I can't do this. But I think the most important thing is some of the metrics where it's, somewhere in and around 75% of founders regret selling their company within a year or 18 months after selling it, because in large part because they're not prepared. And that hesitation to sell can translate into concern or company specific risk in terms of valuation and pull it down. So I think it's really important for founders to think about that. And I think now with some of it, tie it to the AI, I think some of these emerging AI tools now, you can begin to have these conversations with the founders, and then through the analysis of those transcripts, you can start to understand where those hesitations are. You can start to measure where they're at. And so I think some of these tools can be good coaching tools or preparation tools to at least assess where the founder is, and then start having those conversations. Because if the founder isn't willing to leave, the value will go down, or the deal will eventually just get delayed to the point where it dies.
Any other thoughts on that?
Charles and I are working on two companies right now, Will, that where we were asked by the consultant that brought us in to take the word exit out of our logo because they didn't want the founders to know that they were preparing for an exit. And Charles and I had a long conversation about this. I think part of it is, I'm smiling, but it's really a role reversal. It's the identity. I was at an Exit Planning Institute meeting the other day in Philadelphia, and this topic came up constantly. It was the role reversal between the founder's identity and their role in life. And if their identity is their business, they're going to have a heck of a time disconnecting from that identity when they go to sell their business. So it's sometimes a deeply psychological conversation that you need to have with the founders to determine what their purpose is. And as Will said, to play golf 7 days a week, 24 hours a day is not going to work. That's not a plan, but interesting.
And I'll add to that also that AI absolutely helps accelerate all of this. But we've also, we partner with some neuroscientists who help support the owner in their transition, because they don't know what they plan to do. So when those founders, when the buyers see that the founder has support, not only operationally, so that the company is owner independent, but that they have support emotionally, that actually creates, again, this buyer confidence that the company is run as it should, and that the founder is supported by the right people and has the right plan in place post-exit.
Well, and I think one of the interesting things about preparing for an exit is that some founders don't want to leave. And in those cases, they should be working with groups that are going to support having a founder involved for at least that next hold period or foreseeable part of that hold period, to have that transition and to be able to continue to work with their with their business. Some founders are great. Some founders really are better suited for the next phase of growth than they were for the first phase. And that could be viable. But one of the interesting, when my family business sold, we had a lot of people pitching us on the fact that they wanted to keep us and all these things. And you'd look at their portfolios, and they didn't have a single founder that was still leading any of these companies. And so they were saying what they thought we wanted to hear, when truly the family components in the business wanted to get out. And so we would have been far happier for someone to say, here's our strategy, here's what we're thinking. Does that align with what you're doing? And going through a full process of preparing for an exit before you get to a place where you've hired your bankers and gotten involved with your brokers and things of that nature allows the leadership and the owners to figure out, what do they want to do after this? And it's not a question of, am I going to go fishing or golf or take the money and start a new business? It's more, where do I see this business headed? Do I still want some measure of involvement? Do I even want to roll over any of my equity if I'm, if I'm a passive investor on this, just to say, hey, I think it could be a good deal going forward under your leadership? All of that comes from being thoughtful and intentional during an exit planning exercise. And I think that being able to use tools that can take people out of the mindset of the stress of pulling the data together and more into the mindset of how strategically is this capturing what our business does and is, can really help get everyone on the same page there.
Excellent. So This is a question for everyone, and you've touched on it in several spots in our conversation today. Are you seeing an increased appetite for um, real-time operational data alongside traditional financials in the diligence process?
Absolutely, Will. In our case, yes. And what we found too is that artificial intelligence has become an augmentation to human intelligence. It's not, at least in the foreseeable future, it's not going to replace human intelligence. We have to understand the financials. We have to understand the people aspect of it. We have to understand the future guidance. And while AI, the tools, the diagnostics tools that we use are incredibly helpful, they're incredibly insightful. We ultimately have to make those decisions along with the leadership team. So, it's an exciting time. And as long as we use AI as a side-by-side tool to augment some of the decision making, I think we're going to be in really good shape going forward.
And I think,
Yeah,
oh,
go
sorry,
ahead,
Charles,
Lindsay.
please.
No, go ahead, Lindsay.
I was just going to say very quickly that there's a lot more demand for real-time operational data, period, in exits or otherwise. And the groups that are better able to capture that and utilize that are better set up for the future where we're all headed. Charles?
That's exactly what I was going to say.
Perfect. So as another question for the group, where do exit plans fall short? And, how can these performance metrics really shore up and improve those outcomes?
I'll jump in here. I don't think, as Lindsay said a few minutes ago, a lot of times leaders, founders want to sell their business, and the exit planning process is like, when I want to sell my business today, and you should have started 3.5 or 4 years ago. But let's take what we have now and look forward. Most organizations are not prepared to sell. Interestingly enough, I've had a television show for 8.5 years, and one of the questions I always ask some of the leaders are you intimately familiar with your financials? And some of the answers are astounding. I mean, no, I think I rely mostly on my CFO. Well, do you know anything about your financials, your cash flow, your trial balance, your balance sheet? And I think when you begin that process to sell your business, something maybe that you started or one of your family members started, dig into things, be conscious of what you are trying to sell, that asset, and use us, all 5 of us, to help you maximize the value of your business, so that you can enjoy the hard work that you put in there. But prepare early, as early as you can.
And to touch on that, I think it's the wrong word. I don't think it's an exit plan as much as an exit process. It's something that you should always be doing. So it's, as soon as you put the final piece of paper on something and put it on a shelf, it's already obsolete. So that's why I think if you're just continually, back to Mark's point, reviewing your financials, understanding your financials, looking for opportunities to improve, and you're just doing good business, but just doing it in context with an awareness of what a due diligence process looks like, you're just going to improve your operations. You're just going to improve your ability to sell. And then more importantly, the flip side is, what happens if someone shows up tomorrow and says, I'm interested in buying your company and it's a good offer? Do you have everything ready to sell? So you got to look at it both ways. But I think if you look at it as a process, as something you're continually doing, you're just doing good business, and you're going to end up being more successful long.
Yeah, I couldn't agree more, because at the end of the day, real-time data, and that's the reason why we create these real-time dashboards, data dashboards, is because that allows it to live on. It's not static. It's just continually being updated, so that, and the reason why that's important, to support what Will is saying, is, and what Mark said, there's a huge breakdown from a founder standpoint, owner standpoint, and it tends to occur at a certain intersection. The intersection being there's this ambition, I want to sell my company. A lot of times I want to sell it tomorrow. And the difference between that and execution. And the execution is not ready because really it's unrealistic timing. The valuation expectations aren't realistic. And then, as was talked about earlier, they have incomplete KPI tracking, and they can't support their data story because the KPIs are just off, and the data is not real time, and it's just everything is thrown off. And then on top of that, many times the lack of documentation around key systems and also relationships even. So there are these gaps that are in place that just make that creates this shortfall, back to your question. And all of those can be solved with companies and people like us.
Yeah, I think it's also, to Will's point, it's also important for leaders, owners, founders to recognize that this is a process. It's not a transaction. It's transformational. It takes time. It takes a lot of effort, a lot of planning, a lot of diligence on your part before the buyers come in. So when you say that you want to sell your business, that planning process takes an effort, and make sure you think about it in terms of transformation rather than transaction.
Yeah, great. And just one final parting question before we flip over to the audience to see if they have any questions. You all collect a variety of data. You are working with a lot of different leaders. Any red flags that you have seen or trends that the AI has shown up, here in the last 12 months?
I'll go first. I think there are many, and there are just multiple cases that indicate this, and they really show up, post-close and underperformance. And that's when there's overestimated cost synergies, and especially when it comes to fragmented roll-ups of data. There's weak, as we've already talked about, there's weak leadership continuity, and from a planning standpoint, there isn't a succession plan, those type of things. And there's also an inadequate customer diversification. So there's customer concentration that will really cause a huge problem, particularly if one of those customers leave, and in that transactional process, post-close, that company will be in trouble more than likely. And then, when operational systems, they're not prepared to scale with growth because there's lack of innovation, there's lack of, systemization, so it can't scale. And so that basically kills growth. And so those are just some things that come to mind when I think about red flags, as well as a cultural mismatch as well. That becomes a big deal, and Mark talked about that earlier.
Yeah, Will, I think to Charles' point, I mean, what we're finding from during the pandemic, there was a lot of quiet quitting and all that. I think there's a lot of folks still in a position where they don't feel engaged in the day-to-day operations of the business. And so you see that the AI tool will allow us to look at lack of or decreased productivity because of the fact that employees are oftentimes not engaged in their work. There's still a lot of virtual work going on, or hybrid work going on. And culturally, I keep talking about the cultural side, but the people side of this business is so critical. And oftentimes I think employees feel as though they're not part of the mothership. And when that happens, the AI, one of our AI agents will be able to determine whether or not they're really engaged in the business operations. And when they're not, we see a drop off in productivity and profitability within the organization. So that's a big red flag. I don't think people pay as close attention to that as they should. Our instruments, our agent, our diagnostics tools that we work with at Exit Systems uncover that. So that's a big red flag.
Yeah. Will or Lindsay, any other thoughts?
I think ensuring it, there was an earlier point about having data cleanliness and strong data governance. And if the information isn't clean enough to produce good information that AI can find and consolidate and make easier, that's probably a flag saying that you're further out from exit than you think you are, because you need the ability to be able to generate tons of information very quickly in an exit process. And with that in mind, making sure that it's as clean as possible, as accessible as possible, and with the appropriate safeguards in place. If those things don't exist, you're not ready.
Will, I have one last thing before we close it out. Charles and I have a partner who has an AI instrument that looks at IP, and they run 220 million queries in 170 jurisdictions around the world for IP overlap. And they've told us some stories that it's pretty remarkable that organizations do not recognize that they are infringing on a patent or infringing on IP in an organization. And one story of which was a multi-million-dollar issue with AWS, with Amazon. And this partner of ours uncovered that during the diligence process. So a big red flag, not something a lot of folks think about, but certainly something that needs to be top of mind for organizations out there. If you're patent infringing or IP infringing, it can be a problem.
Yeah. Great. Well, we don't have any audience questions, so thank you for participating in your time. Thank you, audience, for joining us today. We hope this conversation sheds some light on the deal killers you can't see in a spreadsheet and how AI is changing due diligence for stronger outcomes. This roundtable is part of a monthly series from PL3, the Performance Leadership Learning Lab, where we explore topics like leadership, organizational performance, AI, cultural alignment, and investor decision-making in greater depth. Next month's topic will be titled Bridging Cultures, Bridging Values, or Bridging Cultures, Building Values, the Leadership Imperatives in M&A. We hope you will join us. To learn more about us, visit us at plllab.com. We'll see you next month. Thanks again.